Hello, everyone, and welcome back to today's daily analysis. Today's Thursday, 30th May 2024, and here are key things that you need to know. For our US dollar index has seen a sharp recovery, hovering near the 105 mark on Wednesday. In this environment, investors remain risk averse. The constant calls for patience from the Fed officials have led to a reduction in bets on a rate cut at the upcoming September FOMC meeting. In reaction, the US Treasury yield has recovered. The US dollar index is slowly falling as the US market prepares for the release of economic data this week. The US released strong confidence and housing sector data at the beginning of the week, but the dollar remains weak ahead of the release of high level data this week. Despite some mild declines and the market continuing to give up hopes of the rate cuts in June or July, the resilience for the US economy has allowed the Fed to maintain a cautious stance, which has cushioned the dollar. Thursday's GDP and the PCE will set the stage for betting on the upcoming Fed's decision. The current odds are for the first rate cut in September. The daily chart indicators continue to show increasing bearish momentum for the US dollar index. The technical indicator RSI maintains a negative slope and remains in the selling zone, indicating widespread selling pressure. The bearish momentum is further evident in the red bar of the MACD indicator. Currently, the US dollar index remains above 105, market psychological level, and 104.92, 38.2% Fibonacci retracement from 102.35 to 106.51, indicating short-term dominance of bulls. Therefore, on the upside, 105.45 May 14 high and 105.74 May 9 high can be watched. For the crude oil, it retreated on Wednesday, pairing recent gains, ending 3 days of bullish momentum and retreating below $80 a barrel. The market risk appetite faded midweek as investors hesitated over falling demand for US treasuries, and energy markets grew increasingly concerned ahead of US crude oil production statistics. The WTI crude oil rose on Tuesday as energy markets looked to the Organization of the Petroleum Exporting Countries, which is OPEC, and its extended network of non-member partner countries, OPEC Plus, to maintain production cuts in an attempt to curb global crude oil production in the face of disappointing demand. The OPEC began holding online-only meetings on Sunday, June 2, and the Crude Oil Alliance is widely expected to maintain a voluntary production cap of 2.2 million barrels per day that has been in place since the third quarter of 2023. The global crude oil demand has failed to rebound in 2024 to an extent that energy markets expected, and the global production risks far exceeding the amount of crude oil that the global economy can absorb. WTI oil prices climbed more than 5% in the previously low to $76 per barrel, breaking through $80 and rising by more than $1.5 on Tuesday. The WTI oil prices are testing last week's high of $80 and may be stronger after the recent consolidation pattern. The US crude oil is expected to close higher for the rest of the week, but the upside may be blocked by the 10-week moving average of $81.16 and $82.56, which is the 23.6% Fibonacci rebound level. However, if oil prices fail to break through the above resistance areas, there is a possibility of a downward turn in the near term, with targets to pay attention to $77.51, 50% Fibonacci rebound level, and 76.34, the 15 low of this month. And then lastly, for the spot gold, the gold prices traded in negative territory, around $2,338 after closing higher in the previous 3 trading days. The benchmark 10-year US Treasury yield rose more than 1% on the day above 4.6%, causing gold prices to continue to fall. On Wednesday, the gold prices ended a 3-day winning streak as the US dollar rebounded slightly. In addition, the hawkish comments from the several Fed officials and stronger than expected US economic data dampened expectations of a September rate cut by the Fed. This in turn boosted the dollar and weighed on the dollar dominating gold prices. On the other hand, the geopolitical tensions and uncertainties are likely to boost gold's safe haven assets. Growing demand from central banks will continue to support higher gold prices in the short term. The US Core Personal Consumption Expenditures Price Index will be released on Friday and is expected to rise 0.3% month on month and 2.8% year on year in April. Any signs of rising inflation in the US could raise the possibility of delaying the Fed rate cuts, thereby creating some selling pressure on gold as rising rates will increase the opportunity cost of gold. Technically, the bullish outlook for gold prices remains intact as it remains above the key 100-day exponential moving average on the 1-hour chart. However, the 14-day relative strength RSI is at neutral levels around the 50 midline, suggesting that further consolidation or directionless looks favorable for now. The first upside target would be seen at the upper Bollinger Band line at $2,427. A sustained rise in the yellow metal could pave the way for an all-time high of $2,450. If the bulls break above this level, a rally to the psychological 2,500 mark would be in the cards. On the other hand, the May 24th low of 2,325 is an initial support for gold prices. The next level to contend with is expected at the $2,300 round number mark. Any subsequent selling below this level would expose the lower Bollinger Band line at $2,277. And this is it for today's daily analysis. If you're interested in trading or want to know more, feel free to reach out to our channel. Thank you.